Listen up. Right now, as we speak, 40% of the entire S&P 500 is controlled by just 10 companies. That means if you're investing in a traditional S&P 500 fund, you're putting nearly half of your money in just to the top 10 stocks, whether you realize it or not. That is the highest concentration we've ever seen in stock market history, even higher than the dot-com bubble that wiped out trillions in wealth. Here's what's happening right now as I'm recording this. 54% of professional fund managers believe we're in an AI bubble. Jamie Dimon, the CEO of the most important bank in the world, JP Morgan, he'll tell you that's true, is predicting a serious market correction within the next 6 months to 2 years. The market is at all-time highs, but only 18% of stocks are hitting new highs. That's what we call low breadth. And it is, of course, Rose who taught me that, and we did all the research for this. And look, there's going to be a lot of information in this video, and some people might not like that because it's a little bit information dense. It isn't going to be Netflix. But if you want to take your money and your management of your money seriously, I recommend you download the free research document that I'm going to give you with this. And it's in our community. It's completely free of charge, nothing required, no credit card, nothing. And you can just download that. I'm pretty confident it's going to help you with your investment decisions over the next coming months. Because if you're following the old playbook of just buy the S&P 500 fund, you could be setting yourself up for a brutal wake-up call. When concentration is this high, one sector crash can take down your entire portfolio. So my promise to you is today to show you a different approach. 3 specific ETFs that give you exposure to the market's strongest companies while protecting you from the concentration risk. And by the end of this video, you'll understand exactly how you could potentially position your portfolio for what's coming. My name is Felix Prehn. That was Rose back there who had to run off to chase something. I'm an ex-investment banker. I spent the last 10 years studying how the markets work from the inside out. And I see again and again that retail investors are left holding the bag. So I'm also the founder of the Goat Academy, where we have over 20,000 students. And I'm the co-founder of TradeVision.io, where we give you the news and the data that Wall Street has access to and most retail investors don't. So my mission here is very simple, and give you the same tools, the same strategies that Wall Street uses, but in plain English. So anybody can understand it, no jargon, no BS, just actual information and probably more kittens than you care for. So let's dive straight into what's really happening in the market right now. Here's the thing most people don't understand. When you buy an S&P 500 ETF, you think you're diversifying across 500 stocks, right? That's what you're being sold, 500 stocks. You think you're spreading your risks, but the reality is completely different. The top 10 make up 40% of the entire index. We're talking about companies like Nvidia, Microsoft, Apple, Amazon, and so on, the so-called Magnificent 7 stocks. They alone count for 34% of the S&P 500. And to put this into perspective, these guys, the equivalent of the dot-com bubble, during the height of the dot-com bubble, they made up 26% of the S&P 500. So we are monstrously higher than where we were then, and I think we all know how that ended. Now let me explain something that's called market breadth, because it's something that everybody on Wall Street talks about and very few retail investors talk about because it doesn't exactly sound very sexy. It's basically how many stocks are participating in a rally. When market breadth is high, it means lots of stocks are going up together. That's healthy. When market breadth is low, it means only a handful of stocks are dragging up the index while everybody else is falling flat or failing, and that's dangerous. Right now, as I'm recording this, we have extremely low market breadth. Only 18% of stocks are at all-time highs. A few days ago, as I'm recording this in October, the S&P 500 hit 6,900 points, but 80% of the stocks in the market went down that day. Think about that for a second. The index is hitting record highs, but 80% of the stocks inside are going down. That's like saying your basketball team won the championship, but only 2 players scored all the points, while the other 8 stood around doing nothing. There are 10 players in a team, aren't there, in basketball? Please tell me that's true. So why is this critical to you? Concentration is this high, breadth is this low. You have maximum risk with minimum diversification. So if those top 10 stocks, because that's really all it is just 10 stocks that are holding up the entire world stock market. If they stumble, and they will eventually, because that's how markets work, your diversified S&P 500 fund is going to get hammered. You thought you had 500 companies protecting you, but really you were betting on 10. So what's the better strategy? Concentrate a bit more. Seriously, let me walk you through 3 strategies here, 3 ETFs, and this isn't financial advice. I'm not telling you what to buy, but I want you to think about this in a different light, and hopefully this is going to be a great place to start that thinking. So a lot of advisors out there, I'm not an advisor, I'm an educator, they'll tell you buy small caps, buy international, go into sector-specific funds. But it's A, overcomplicating things, B, you don't really know why you're doing it. So let me tell you what the smart money is doing. They're focusing on the S&P 100. Now what the heck is the S&P 100? It's an index of the largest 100 profitable American companies. It's actually technically 101 companies because of dual-class shares, but let's not get bogged down into the really nitty-gritty. These are the titans of American business, the companies that have proven they can survive recessions, market crashes, technological shifts, and pretty much everything else. We're talking about companies with an average market cap of $135 billion. Now, you might be thinking, Felix, if concentration is the problem, won't the S&P 100 be even more concentrated since fewer companies are in it? You win a gold star. Great question. Now, here's why that logic is slightly backwards. Point 1, you're already concentrated. When you buy an S&P 500 fund right now, you buy the S&P 500, 61% of your money right now is going into the top 100 stocks. So what about the other 400 companies? They're basically just along for the ride, contributing almost nothing to your returns, but adding a ton of names that clutter your portfolio. And second point, you have a better quality filter. The S&P 100 acts as a quality filter. These are companies that have massive scale and a competitive advantage, a proven ability to generate cash flow, stronger balance sheets. They can weather any storm. Management teams are better. They've delivered through multiple market cycles. To make it into the top 100 companies in America, you have to be doing something right. So these aren't startups hoping to disrupt an industry. These are companies that already won in their industry. And point number 3 is you have less volatility, so less ups and downs. Why? Because when markets get choppy, investors flee to quality, and quality means established, profitable mega-cap companies. So during a market crash, small and mid-cap stocks get absolutely destroyed. The big guys in the S&P 100, they have resources, they have cash reserves, they have market power to weather most storms. And in 2025, the S&P 100 has actually outperformed the S&P 500. So I'm recording this, it was up 18% year-to-date compared to 15% on the S&P. Why? Because in a concentrated market, where the big are getting bigger, you want to be in those big companies, not diluting your exposure with the 400 other riff-raffy stocks. So how do you actually invest in the S&P 100? Well, the primary ETF is called OEF. OEF is a ticker symbol. Don't just run out and buy it blindly. Think this through, read the research report, and obviously talk to somebody about it. But here are the key details. OEF is a ticker. They have an expense ratio of 0.2%. That is, in fairness, higher than most ETFs that cover the S&P 500. So if you invest $10,000, you will pay $20 a year in fees, not negligible. It tracks the S&P 100 index. And it is, as I say, higher than VUG and SPY and so on. And you're right, those funds are cheaper. But here's what you need to understand. You're not paying more for the same thing. You're paying slightly more for potentially better quality holdings and lower volatility. So it's like an insurance premium that you're paying more. Again, I'm telling you to buy it, I'm just telling you what I'm doing. So before we move on to ETF number 2 and 3, if an ETF is not what you're looking for, because you just happen to click on the wrong video, then I will also teach you how to just pick better stocks. Or rather, how Wall Street says to pick better stocks, which is around about the same thing. And there are 3 rules that 99% of retail investors have never even heard of. They're very simple. You can learn them in 15 notes. If you want to learn those, leave this video. Go to felixprehn.org/get-free and learn literally in 15 minutes what those rules are, how that works. I'll walk you through it. It's a little video I recorded for you, and I hope you're going to get a ton of value out of that. Then if you want to come back to this, brilliant. If you don't, stay with that. Now, we've covered my core holdings, the S&P 100 for quality and stability. But you can't just stop there. Well, you could. But if you are a little bit more eager for real wealth, you might need some growth. And the S&P 100, well, it's weighted by market cap. That means the biggest companies have the biggest impact. While that's great for stability, it also means you're somewhat limited in your growth potential because you're already in the largest companies. It's harder to grow from like 4 trillion to 10 trillion than it is from, 100 million to 200 million, right? So that's where the second ETF comes in, a growth-focused ETF. Now let me explain what growth actually means in investing terms, because there's a lot of confusion around this. Growth stocks are companies that are expected to grow their earnings faster than the overall market. They're typically reinvesting their profits back into the business. They're not paying dividends. They focus on innovation, market expansion in sectors like tech, consumer discretionary, healthcare, care, and they trade at higher valuations because investors are willing to pay for future growth. Now, some people hear growth stocks and think that means risky, speculative companies, but that's not what we're talking about here. We're talking about established growth companies, businesses that are already profitable but are still growing faster than the economy as a whole. And look, we're in the middle of a massive tech shift with artificial intelligence right now. Love it or hate it, AI is real. It's going to transform how we work, how we consume, how we do business, everything. Companies that are at the forefront of AI development and implementation are going to see explosive growth over the next decade. Now, I'm not telling you to go and buy some sketchy AI startup that has no revenue. That's gambling, not investing. What I'm saying is you may want exposure to the established companies that are winning the AI race. The ETF that I'm looking at here is called VUG. My handwriting is pretty terrible. The U's look like V's. I literally used to have a teacher who marked me down every time when he saw one of my V's and U's because they always looked the same. Bastard. He was a nice guy, actually. Didn't really work out though, did it? Now, they have an expense ratio of 0.04%, so it's cheap, right? It tracks the CRSP US Large Cap Growth Index. Repeat that after me 3 times. Tongue twister. They own about 185 stocks. So what do you get when you buy VUG? Well, the biggest part of the pile is Apple. Bear in mind, Apple is in everything. You get Microsoft. You get Nvidia. You get Meta. You get Google, you get Tesla. Now you might notice something. These are also all in the S&P 100. So why the heck own both? Again, another great question and one more gold star. Here's the difference. In the S&P 100 fund, these companies are weighted alongside 94 other companies, including Coca-Cola, Procter & Gamble, Walmart, companies that are more stable but grow slower. In VUG, you're overweighing specifically the growth companies. You're saying, I believe in technology and innovation. And I want more concentrated exposure to that theme. Now, VUG is going to be more volatile. That means more of this. So it's going to be great when the market's good. It's going to be not so great when the market isn't. We saw that in 2023, we saw that in 2024, we saw that early on in 2025, right? But when the markets turn, we hit a recession, and people get scared, VUG is going to drop harder than the S&P 100 ETF. So it's a trade-off. You get potentially higher returns in exchange for higher ups and downs. So that's why you don't put 100% of your portfolio into VUG. It's your growth sleeve, not your whole strategy. Now, if you're 20 years old and you've got the stomach lining of, titanium, then, go nuts. But you want to think this through. Now, let me give you one more option. If you want even more focused technology, and I'm going to have to find some space here in I should have had some more space. There is another one that I quite like, which is called VGT. It's the Vanguard Information Technology ETF. The expense ratio is slightly higher. It's 0.09%. It's focused on IT sector, right? A bit more concentrated. It only owns tech companies. VUG includes growth companies across all sectors. What do they own? Well, you guessed it. They own Apple. If I could spell Apple. They own Nvidia. Yep, you guessed it. But then it becomes a bit different. Microsoft, still the same. Again, I can't spell. Then you've got Broadcom. Didn't have that so much in the last one. Oracle. So if you believe technology is going to continue to dominate the market, well, then VGT gives you that pure play exposure. But remember, more concentration means more risk. Now, I kind of prefer the VUG because it just looks at growth across a bunch of sectors, not just tech. So you get growth in consumer companies like Amazon, growth in healthcare companies, growth in communication companies, a bit more balanced. So you want to look at that. How much of your portfolio should be in growth? Honestly, depends on your age and your risk tolerance. If you're under 35, I'd say you could be up to 50% in basically growth, right? If you're over 50, maybe it's 20 or 30%. So the younger you are, the more ups and downs in the markets you can handle because you've got more time to recover from downturns. I promised you a third ETF. This is now the fourth ETF. This is your defense. So we talked about core, right? We've done core. We've done growth. Now we're going to talk about defense. And it's the part that helps you basically sleep at night when the markets get unstable. It's your stability anchor. And many people think this is where dividend ETFs come in. And look, dividends are fine. They motivate a lot of people to invest. I've got nothing against companies that pay dividends, but it is usually neither tax advantageous nor particularly valuation advantageous. So I think there's a better approach. And let me just rant on for a second about dividend-focused ETFs. Traditional dividend ETFs, and there are many of them, like VYM or SCHD, they are overweight in sectors like utilities, REITs, consumer staples, financials, especially regional banks, because they all pay quite nice dividends. Now, some of those sectors are fine, but there's a problem. You're concentrated in a market where the top 100 companies are driving all the returns. Your dividend ETFs specifically are designed to avoid those top companies. Why? Because high growth companies like Nvidia, Amazon, Meta, Alphabet, they don't pay significant dividends. They are reinvesting their cash because they're growing. So when you buy a dividend ETF, you're systematically excluding the exact companies that have been driving the market and are likely to continue doing so, in my humble opinion, and are delivering all the market growth. So is that the smart idea? Now, there's a second anchor to this. If the Fed keeps cutting rates, and I believe they will, because Trump will appoint somebody who will be a poodle and who will cut rates, and what happens when interest rates come down? Who benefits more? Is it number one, dividend stocks, or is it number two, growth stocks? Put it in the chat down below. Put a 1 or a 2 down there. I'd love to see a bit of a poll here. Well, let me break it down for you. Lower rates do one thing. It's a bit complicated, but they increase the value of future profits. Now, which companies have greater future profits? Growth companies or dividend companies? It's growth companies, right? Because their profits are going to grow more. So what actually goes up a heck of a lot more is growth companies. They benefit from lower interest rates. So my third ETF is perhaps a little contrarian. It is more of the S&P 100. Yeah, ticker symbol OEF, the first one we talked about. Because, look, I know we already covered this, yes, but hear me out. The S&P 100 is your defensive position because the companies are recession-proof. When the recessions come in, it'll eventually come in. Where do investors run? They run to quality. They run to companies with strong balance sheets, consistent cash flow, competitive moats, pricing power. That's where the S&P 100 is. These companies have survived, right? Reason number two, you get better dividend growth anyway. Because here's something most people don't realize. Many S&P 100 companies do pay dividends, and they've been growing those dividends faster than traditional dividend stocks. Microsoft has a 10% annual dividend growth. Apple has an 8% annual dividend growth. JP Morgan has a 7% annual dividend growth. So you're not sacrificing dividend income by focusing on the S&P 100. You're actually getting dividend growth from potentially stronger companies. And then the third thing is, it's not all about dividends, my friend. It's about capital appreciation and income. So with the S&P 100, you get potentially higher stock prices, much more likely, and you get some dividends and certainly faster dividend growth than in the typical dividend ETFs. In my humble opinion, over a long period of time, say 10 or 20 years, the total return, so price increase plus dividends of the S&P 100 is likely to beat a pure dividend ETF. Just because of the capital appreciation. It makes up for any dividend details. So what's my plan then? It's three-part. Number one, it is OEF and say 40% of the portfolio. I'm not telling you to do that. This is just a general starting point of your thinking. That's the core part, right? This is core quality holdings, mega cap companies, lower volatility, more defensive. And then you might want some growth. Maybe you want some VUG in there. Maybe if you're a bit youngish, that could be 40% too. That's your growth engine, more tech. Big overlap with OEF, by the way. Yeah? You're kind of concentrated here. And then number 3, well, we have more OEF. And that sounds a bit silly, but it's essentially very simple. So really, it is just a 1 and 2 clicks and you're done. And I like simplicity a lot. Now, is that all I do? No, I'd be lying to you if that's all I do. What I actually do looks more like this, that I have this thing here, that's 50%. And then the other 50% over here is called follow the money. So I follow a strategy that my mentors taught me, all ex-Wall Street guys who basically look at where is the money flowing. And I find this personally very profitable. I'm not promising you any returns, not telling you should do it. But if you want to learn those 3-step strategies, then go to felixprehn.org/get free. And if you just want to get stuck in the ETF world and research more into that, read the research report I'm giving you for free in our community. And my hope is that simplicity is helpful for you. I always think that's true. I had a great mentor. And he said to me, Felix, if in doubt, keep it simple. And I think it's a great lesson. I see people who have portfolios of like 19 ETFs, and I'm like, you realize all of these own mostly Apple? You could have just bought Apple, or could have just bought one ETF and leave it at that. And maybe you think the growth thing isn't needed. And that's also fair enough. Just put everything in the S&P 100. But I'm not telling you what to do. I'm just saying, think a little bit through the traditional mantra of just buy the index, leave it at that. Think about if you're buying the right index. And I'm hoping that this was helpful to you. If this was, share it with a friend or a golden retriever. And I wish you great success. Take care. The US dollar has been the world's reserve currency for 81 years, but that dominance is quietly crumbling right now. The Guardian just published trust in the United States dollar is eroding. The question isn't if the dollar will lose supremacy, it's when. JP Morgan is warning about de-dollarization.